What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves, 45 days, free, no risk, no friction, just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to the Sparta Market Outlook Podcast, your weekly snapshot of what's really driving the global markets. I'm your host, Rachel Williams, and it's been another packed week of data, decisions, and some fairly punchy market moves across the barrel. So this is episode 48, and I'm joined by Jorge, back for a second week run-in. Hi, Jorge.
Hello, Rachel.
As well as Jameson Filler joining me today. Hi, both.
Hi.
Good morning.
So the team are here to help me make sense of what remains quite a choppy market, even with some of June's geopolitical risks seemingly fading into the background, for now at least. So we're kicking off with a big story from the weekend. So OPEC Plus has opted to raise output. And if you were listening last week, you'll know Neil called it nearly to the barrel, actually. So from there, we'll deep dive into the diesel tightness, shifting gasoline arbs, naphtha recovery, and what's really happening in physical crude again. So we'll also kind of share with you a side serving of tariffs, of course. So look, there's plenty to get into this week. So Phil, do you want to start us off with what's caught your eye this week in stats and more broadly?
Yep, sure. Thanks for the intro. So as you anyway pointed out, Neil, last week said that low inventories globally were going to be the justification for OPEC Plus raising output, and that's true. That proved to be correct, and it was even mentioned in the OPEC Plus meeting notes. I think the thing to add on top is what my colleagues have anyway been talking about in the various pieces that we've written this week about the lack of this quality of crude, that medium and heavy sour crude that is going to be coming back into the market. And that's really given, I think, core OPEC the confidence to hike output and OSPs in tandem. So, crude quality is something that we touched on over the last few weeks. We'll talk about it again today. We'll talk about it for the next few weeks. I think it's going to be something that keeps on going in the market. And I think more broadly, something else that was mentioned last week was looking forward to the latest STIO estimates. So for US supply, they came out 2025 average supply for the year for US is revised down 50 kbd versus last month's estimates. So not a huge change, but actually the biggest revision was the Q2 number. So that was down by 100 kbd. So that's more kind of a revision of what's happened rather than changing the estimate or the forecast. They revised Q3 down 50 kbd, but ended 2025 at the same level as they did the previous month. So that was a little bit odd because we've seen kind of weak drilling numbers, weak frac counts, growing kind of consensus, it seems at least, that flat price expectations towards the end of the year, moving in towards the low 60s maybe. So I think the outlook on the supply move into next year is going to be coming into a little bit more scrutiny as we go along. That outlook, that kind of exit 25 number not being revised down looked a little bit odd to me.
Okay, so one to watch then for potential further revision downwards.
Indeed. In more kind of immediate US stats, because we're recording this on a Thursday morning, we get to have a nice EIA update. And the EIA numbers basically confirmed the API numbers from the day before on crude to the barrel almost, so 7.1 million build there, with products drawing. So gasoline drew almost 3 million barrels. ULSD specifically drew 1.5 million barrels. PAD 1 and PAD 2 diesel now looking really quite tight. I mean, more so than before, but I'll let James talk about that in a second. Cushing had a little bit of a build, 500,000 barrels. So the majority of those crude builds were coming in pad 3. 5.8 of the 7.1 million came from pad 3. And it was really just because pad 3 exports were low. Another sub 3 million barrels a day print, second week in a row, which aligns quite nicely to our kind of very highly unworkable relative pricing for TI exports that we showed in the platform late June, early July. So it just looked as though, there wasn't a whole lot of call for TI globally. Yeah, that has reversed, at least now looking forwards in what we have on the platform. TI is looking much better into Northwest Europe. It's looking much better into the Far East again. So we're looking for a bit of a reversal here, seeing maybe some stronger export volumes out of pad 3 in the next couple of weeks to see those numbers picking up and the inventory build slowing at least.
Okay, so no real surprises then, kind of in terms of EIA. It's pretty much kind of in line with where we thought that it was going to be, albeit kind of, okay, yeah. We'll lead into that with distillate and crude.
Exactly. So just rounding off this top section, I need to squeeze in a very quick mention of US tariffs. So, that original deadline was supposed to be yesterday, and we got some bravado from Trump at the beginning of the week about, pulling some fresh numbers out of somewhere on the levels of tariffs that he's going to throw onto various countries to bring them to the table. But it came with a delay that we're not actually going to impose these until August. We're going to give some more time to negotiate those deals. I think equity markets got a bit of an initial spook, but the assumption seems to still be that deals are going to be made and that this kind of taco mentality prevailing. And the final bit is that, final bit of headlines or geopolitics is that we've seen the first attacks from the Houthis on shipping in the Red Sea since December 24. So attacks on both Sunday and Monday of this week. I don't think anything since then, but insurance premiums have been very quick to rise again. So just a little bit of, maybe a good segue actually to start talking about the most relevant product segment at the moment and the one that's reacting to that, which is probably diesel, I'd say.
Yeah, okay. Thank you so much, Phil, for that. James, I'm really keen to get your take on the events of this week. I think internally we were all actively watching kind of the ICE Gasoil expiry. Talk me through, is the pricing kind of from this week rational reaction of the market? And did anyone see it coming?
Yeah, well, as you say, the uptick in ICE Gasoil spreads in the front has been pretty, mesmeric, to be honest. I mean, the front ICE Gasoil spread has moved up from plus 24 to over plus 70. At some points yesterday after the EIA stats, it moved up to over $105 per metric ton. I couldn't stop watching it, to be honest. I mean, heating oil and Singapore spreads and global diesel cracks have largely followed that. Although interestingly, kind of further down the curve, they seem to have found a little bit of a ceiling. But there's clear tightness being indicated in the global diesel markets. But that kind of spread does feel a little bit detached from fundamentals at this point, I must say. But for sure, July, August, ICE Gasoil, which is set to expire in a few hours, will surely go out very strong. And really, we're seeing now that with this pricing that both jet and fuel oil regrades to diesel have been declining rapidly, have been widening essentially. So that should be incentivizing some movement into the diesel pool of jet or conversion of fuel oil into the diesel pool as well.
Fair enough. Look, the stats are really tight, kind of, it seems, for PAD 1 and 2 diesel inventories. So can we say how much of that then is refinery yield, refinery run, limitations versus arb flow? And how does that kind of lend itself back into that diesel tightness piece?
Yeah, as you say, really, the pricing is really indicating this tightness. So the HOGO has widened further. Heating oil spreads are indicating real US tightness. Already we saw the heating oil of July expire at the end of last month, very, very strong. And the EIA stats yesterday really offered little respite. So demand, which was already up last week's stats, has continued to move up. Crude runs remain really high, particularly in the US Gulf. But despite increasing diesel yields, kind of high diesel exports, increasing diesel demand mean that diesel stocks have really, really drawn. And I speak into the kind of flip side with jet. US jet stocks are really high. So actually US jet exports have been at record levels for the last week. We've got the situation now that Middle East and even North Asian diesel arbs land better than the US Gulf into much of Latin America, even the US West Coast, and even close into New York as well. You would think that these open arbs into the heating oil complex should put a ceiling in heating oil spreads in the short to medium term. And kind of a thing that's kind of surprising me with these kind of tight stocks is that because US Gulf freight rates have really come off over the last week or so, these arbs have remain open or have opened from the US Gulf into Europe and into Latin America. So it's quite a bit of a surprising picture there.
Yeah, fair enough. So continuing that drawdown of stocks then
Indeed.
from not very much. Yes, Phil?
Is it
Sorry.
kind of the pad 3 to pad 1 story again that we had, I think, last year, even at the beginning of this year? Pad 3 builds, pad 3 can still export, but somehow there's a disconnect between pad 3 and pad 1, and I guess Colonial is full and could be fuller, right?
Yeah, well, that's something I've been thinking about with customers over the last few weeks, actually, because we've had quite good runs in the US Gulf. We've had decent diesel stocks in the US Gulf alone, although they have started to draw down now, actually, over the last few weeks. I think it's mostly been, and the theory that I've been working on with customers is that because we've had these really high RVO costs, so that's kind of been incentivizing customers rather than selling it inland to export, which is why we've still seen quite high diesel exports from the US Gulf, is my supposition. Actually, I was speaking to a customer last night about the Colonial ARB, and it's on cycle 40 now, and that's really gone out. That's really, really strongly allocated. It's completely full. So I guess it's starting to react now that people are starting to move up the Colonial pipeline ARB, more diesel, to react to these low pad 1 stocks.
Yeah, okay. Put some pressure back on pad 3 though, right?
Indeed.
Okay, so look, you noted the AG, West Coast India, and even North Asia landing better into the US Gulf Coast, landing better than the US Gulf Coast into key markets in the Atlantic. So is that something that we're expecting to kind of last for a little while?
Yeah, well, there seems a bit of a different picture in Asia, actually. So opposite to the HOGO, both the Gasoil and Jet East-West have really continued to widen dramatically over the last pretty much since the end of the Iran-Israel conflict, I guess. They've been widening pretty dramatically. So Middle East diesel ARBs and jet ARBs are open into Europe and even into parts of Latin America. So they're clearly pointing west. Freight rates in the Middle East for LR2s have really eased since the slowing of that same Iran-Israel conflict. Although it has to be said that a caveat there is the continuing or the restarted attacks by the Houthis in the Red Sea and the effect on insurance premium freights that possibly could come there as well. Part of the solution for the diesel shortage in the Western Hemisphere will have to come from Asia, I think. But as I've just said, with attacks by the Houthis in the Red Sea, there remains some kind of uncertainty about whether these flows will come very soon or not. So it's important, something to monitor there.
Yeah, okay. So taking a bit longer to get here then, but there should be volumes on the way already to help ease the situation come August, do you reckon?
Yeah, so it feels, when you watch that massive tick up in ice gas oil spreads, it kind of feels a bit scary to talk about short positions. But we've got now Middle Eastern ARBs for diesel and jet open into Europe, and even into Latin America, and clearly pointing west. That should offer some relief. We've got refining margins really, really strong, mostly led by diesel, and regrades, as we spoke about with fuel oil and jet, are moving to positions that either incentivize moving into the diesel pool or extra diesel production. We've got probably maybe more of a long-term story. We've got OPEC plus increasing heavy crude exports at some point, which should lead to increased diesel production globally. And we've already started to see that the structure for August, September has already started to slow down and find a bit of a ceiling. So that could lead you to a bit of a bearish position, I think, now.
Fair enough. Your next bullet point, so spoiler alert for everyone out there, we do have some form of script here, but I see your next bullet point just says caveats in massive letters. So what do you want to bear in mind before we can start selling August temp spreads?
Yeah, I kind of maybe gave away a little bit of the punchline, but just really the strength in global diesel market seems incessant. The draws in the US are quite scary, if anything. The heating oil complex, as a result, remains very tight. You've got the restart of the Houthi attacks in the Red Sea, and we've seen what that does to kind of the diesel supply chain or distillate supply chain in the past. We've got this continuing feeling that because of these light crude slates, that despite high runs, diesel stocks can just not be gotten to build in the Western Hemisphere. And then we've also got a pretty large maintenance program starting up the beginning of October in the US Gulf, Northwest Europe, Middle East, and East Asia. So really the question is, are we building stocks? We're not even really building stocks at all, but are we going to start building stocks enough before that maintenance period? It's a very open question, I think.
Yeah, fair enough. Or do we end up going short into kind of Q4? Phil, keen to get your thoughts on crude slate and what that means for the distillate complex in terms of heavy crude coming back to the market and timing. We touched upon it last week. We'll pick it up again this week. But before we delve into that, let's complete the light dense part of the barrel. So look, gasoline's had a roller coaster week. Last week we were bullish. Now I see in your latest commentary note that says that spreads are starting to look a bit toppy. So what has changed so quickly?
Yeah, it's funny how things can turn around that quickly. Last week, as you said, everything was looking supportive, especially for ARA. We wrote that August, September was a bit of a buy. ARBs out of ARA were open, east and west. Gas nap was a little bit lower. It was helping to bring down those EBOB blend margins. And August EBOB spreads moved from about plus 12 to plus 16 now. But since then, EBOB and RBOB spreads have hit a bit of a ceiling. And the picture for European gasoline in particular has done a bit of a 180. So it starts actually in the east. So Sing 92 has come under a lot of pressure from higher Chinese and Indian supply, as well as kind of normalizing freights in the east that have allowed lower landed diffs into the pricing center. So it's improving kind of blend economics in Singapore and in AG. That's blown out the east-west. That's gone from -5 to -7 in a week, which has completely shut any of the ARB outlets that we were talking about for ARA into the east. And it's actually now putting AG ARBs back into kind of direct competition with ARA into West Africa. The caveat on that is that actually the West African econs are anyway interesting, because regardless of how our ARB landed values are looking, it seems as though Dangote is supplying the domestic market at a price that blenders out of ARA and AG just can't compete with at the moment. So essentially we're kind of seeing that the majority of that ARB anyway closed. So if we're looking kind of for ARA outlets, we've shut a lot of out the east and we've shut off WAF now.
Okay, all right. So with East-West shutting and Dangote reportedly undercutting ARA into WAF, then is Europe basically stuck with a surplus barrel now?
Essentially, yeah. And if we were looking at kind of the Western Atlantic Basin, so LATAM destinations that would otherwise be supportive as well, or have been over the last few weeks, ARA was really benefiting from that high TC14. It was allowing it to kind of outcompete the US Gulf into LATAM, into, well, everywhere in the Western Atlantic Basin. But now that TC14 started to come off, the TC14, TC2 spread has narrowed. July loaders are still just about favoring ARA, but from kind of late July onwards, the US Gulf Coast is cheaper again. So all kind of, and gas naps are up a little bit, which means that the EBOB blend margins are even, more attractive again in ARA. So I think in conclusion, I'd have to be slightly braver than I am, and perhaps that's why I'm an analyst and not a trader. But actually, shorting August, September from here could be the call, because every indicator that we have at least is now looking bearish for EBOB when most of it looked bullish last week.
Interesting. Okay. Wow. We'll do a bit of a roundup at the end of the pod and go through kind of some of these calls with you guys. So you've got a little bit of time to think about that, Phil, just to kind of increase your conviction maybe. Okay, Jorge, Naphtha. So we've been waiting for signals of support in Naphtha. Are we finally there, do you think?
Yeah, we've seen some changes since the beginning of July. But I'd say the biggest one has been during the last week. So during the end of June, we saw contango in Europe. And we were thinking that with the ARB very open into the east, that could make no sense. So the market could come back to backwardation. So right now, we've seen this upside or this uptake in the time spreads in Europe. Right now, the August-September time spread is on $4 per metric ton backwardation. So the market is stronger. And East-West remain in the historical seasonal highs, but we've seen correction in East-West box as well. So that means that Europe has outperformed Asia since the beginning of July, mainly on the time spreads comparison. The market looks more balanced now. I say this because since the end of since the ceasefire between Iran, Israel, and US, the market was kind of unbalanced. We saw a very big correction in Europe. East-West was very, very strong. And the arbitrage was very, very open to the east. So the margins from Europe to Japan, Korea, Singapore were the highest we've seen during the year. And so the geopolitical risk was not there, but the prices were still pricing some of it. Right now, the market is much more balanced. We've seen a big correction in FOB prices in Europe. We've seen a correction in East-West, but it remained very strong. And we've seen a correction also in cash diffs in the east. Right now, the ARBs are pointing, the European ones are pointing to Northwest Europe. So that's, and the margin are very close to the Asian deliveries. So there is this big difference right now, and sending it to Asia is much more profitable. So yeah, we've seen this uptrend in time spreads, and I think that the market right now it's much more balanced than before.
Okay, so what's the perspective now going forward off the back of this rebound? So how do you think this is going to play out?
Yeah, we have different fundamentals. I think overall the market is still supported, but we probably have seen the big rallies already. And yeah, on one side, flat prices remain much weaker than in June. So MOPJ and Northwest Europe are close to $70 per metric ton lower than the maximum value that we saw in June. So that has improved the outlook for petrochemical margins during summer, because the petrochemical flat prices has not been that as volatile as Naphtha. So from that side, the market is supported, a better petrochemical outlook for the next 2 months. Then the cash diffs looking at the arbitrage, which has been the main factor supporting the market recently. The cash diff in Asia have corrected, but I don't think, not as much as I was expecting. So the arbitrage remained very tight between Asia and Northwest Europe. And this is always supporting for the global markets. When it's just open to Northwest Europe, it's when the picture is more bearish. So we have some support also from the arbitrage perspective, but it's less than what we were seeing during the beginning of July. And yeah, I think these 2 points are optimistic, but yeah, I won't expect this big rally to keep going on for the next weeks. And one last thing I want to mention, looking at our arbitrage tool, something that we've seen, it makes sense during summer season, but the cash diffs in US have been also very strong. And also we've seen a rally in the ARB of Naphtha as well as in gas snap in Europe. And right now, US is keeping their Naphthas, so the arbitrage is close to other regions because this uptrend in ARB and in cash diffs. And we've seen a big change on our arbitrage panel for the arbitrage of US.
All right. So look, Phil, let's round up today with a bit more of a detailed look at the physical crude market, if that's all right. Sure. So we talked actually at length last week about the refining complex, but yeah, keen to kind of see what's A, changed, you alluded in the intro to TI, and B, your thoughts on kind of this week's market moves.
Sure. The OSP hikes that I mentioned at the beginning have brought those Saudi and the Iraqi grades essentially back into kind of their normal competitive order rather than making them particularly expensive. They were big hikes, but they were seemingly kind of justified on a competitive value basis. I think the market is now waiting for Saudi allocations, which should be out next week, before we start to see real kind of earnest spot trading on AG barrels then. But I think it looks as though that is kind of relatively well supported. And certainly if we look at the margins that refiners should be able to still make out of those barrels, then demand should be there at least. In terms of looking more globally, our signals dashboard is painting a pretty clear picture globally that there's still very much a premium to be paid for anyone who wants to pick up those medium or the heavy barrels. So JS out of the North Sea, WAF medium and heavy grades, the spot AG grades are all demanding pretty decent premiums over their typical landed values. I say typical landed values, they're landed values over the last 12 months, but they still look attractive on that incremental barrel margin basis. So aka cracks are still asking for heavy crudes, right? There's one slightly odd exception, which is the US Gulf Coast medium crudes. We look at Mars and Poseidon for this, which are actually landing quite cheaply at the moment into most places. But I think this is a particular combination of a slightly undervalued freight, maybe, and that's kind of linked to WTI not having been attractive into the east. So freight kind of adjusted a little bit there, which is helping also those medium crudes land into the east. But also there's a potential zinc contamination issue with Mars. So I think that's keeping that particular FOB price under pressure. Otherwise, It doesn't matter where you look, medium and heavy crudes are looking strong. So TI, as I mentioned at the beginning, back open into Northwest Europe versus 40s. It's almost $1 cheaper than 40s on a landed basis. That's with TI Brent at minus 330. So maybe a little bit of room actually on that TI Brent spread. And with Cushing building by about 500,000 barrels in the last reckoning, that should also allow MEH to come up a little bit as well. MEH has been under a lot of pressure recently, but I think it's maybe relieved some of the immediate kind of worries on Cushing. So MEH can maybe move up a little bit. And just to round off quickly, to bring us back to something we mentioned at the top, bit of a fan favorite for the podcast, tariffs. So yeah, the new unknown would be US import tariffs that are slated now for August. Brazil and Iraq both mentioned with 50 and 30% respectively. Obviously, those are both good sources of nice heavy crudes potentially. So those crudes, they're heavier, but we'll see. I think the tariffs have until now often exempted energy imports. So the devil will be in the details when those are released.
Yeah, fair enough. We'll keep updating our tariff tracker as well on our portal. Okay, let's see where we get to then on kind of the crude quality, I say.
I did just have, I had one kind of thought from the last couple of, obviously listening to the last podcast and then listening to James talking today and thinking about solvers for Atlantic or Western Hemisphere diesel supply. I think you were talking last week about how light slates mean obviously it's more difficult to ramp up your diesel yields, but it's also just more difficult to run full utilization, right? So I think the solver has to be coming from the east, and we're seeing eastern kind of balances in the east of Suez, it seems, lengthening through Q3. I know we've got big turnaround seasons coming in October, but it looks as though the market really needs July, August, September runs to be high and flows also to be high coming from east to west on distillate, because it doesn't look as though yet the US and the European markets can solve that on their own.
Yeah, I think it's a timing issue on kind of crude slate, if I'm honest. Whether we can kind of bridge that gap between now and the end of August going into September will be an interesting one. So look, we're going to keep an eye on fixtures and traded deals done in the market, and let's see if we can kind of have a bit of a recap next week to see what move in where. But look, before we move to close, I just want to do a bit more of a recap around the three of you, if that's all right. So what's the one thing that you're looking at going into the end of July, going into August? Or maybe let me stretch that out a little bit. Let me talk about August Sept, if that's okay. So James, where's your focus on distillate?
Everything is pricing in distillate to do two things, really: to increase the movement of conversion of fuel oil and jet into the diesel pool. Probably more importantly, to move distillate barrels from Asia into the Western Hemisphere. So if that happens, which the ARBs indicate it should, then that's what informs my moderately bearish view on August, September. So it's important to monitor those two things.
It's a brave man with this week's expiry going into a bearish view off the back of it, but we'll definitely keep a track of that. Phil, you had a bit of an interesting view on gasoline as well. So have you firmed that one up?
I'm gonna follow it up by being brave as well, and obviously potentially wrong. But yeah, August Sept, Bob, everything that we have looks as though it's turned around 180. I think we've hit at least a ceiling on those spreads, and yeah, I think essentially the ball is in the European pricing's court to make those barrels more attractive again. So yeah, I'm a little bit bearish August European gasoline.
Gosh, right, Jorge, Naphtha.
Yeah, well, from the fundamental side to keep an eye on, I think we have many different things right now. Well, I was thinking about Brazil. Brazil is a big source for naphtha imports.
Yeah.
So right now, energy not impacted yet, or we don't know it yet. So we have to keep an eye on this, and if there is a retaliation from Brazil, because US Gulf Coast is the main supplier, and it will improve the imports from Northwest Europe. Then we have Chinese import quotas for naphtha. They are higher than expected. So I think we have these two things, and we have one more interesting in Italy, the close of a steam cracker during July. So it means lower demand in the Med. So I would pick these three as the main fundamentals. And on trade ideas, I think I'm gonna be less brave than Phil. I've been bullish on European time spreads.
Yeah.
We have seen this rebound during the beginning of July, and right now I think the market is less supported. There are some factors, but I think we have seen already the rally behind us. And maybe if I would have to say something, I think that cracks remain on a seasonal perspective quite low. So we could see, it depends on what Brent flat price will do during summer, but I think we have some potential there in the medium term.
Okay. All right. Thank you. So keeping an eye on cracks on Naphtha then. Phil, round up with crude?
Yeah, we can't get away from the fact that we need to price up, or need to keep pricing up those medium and heavy crudes to get them into the West. I just had a very quick look now. The OSP hikes obviously were big into Asia, but they were bigger coming west. So it's going to be interesting to see how much of that additional OPEC supply can and does make its way into Europe in particular.
Okay, let's unpick that one then for the rest of this week and come back next week with a bit of a view. Okay, so that's a wrap for episode 48. Thanks for sticking with us through some diesel drama, the crude curveball, and everything in between. So a big thank you to Jorge, James and Phil for breaking down another week's worth of volatility, tightness and tactical regrades. As ever, if you've got questions, trade ideas or want to cover something specific, drop us a line. We're always listening, especially if it comes with charts. So don't forget to follow, subscribe, pass it around your trading desks or to the one that colleague who still thinks that contango is a cocktail. So until next time, keep your margins healthy, your freight negotiable and your optimism hedged. Many thanks, guys.
Thanks to you too.
Thank you, Rachel. Cheers.
Thank you.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.